Yo, welcome to the Creative Real Estate Podcast. I'm your host, Rikki Chad Jack. Let's get it. Before I let him talk a little bit about himself, I'm just going to introduce him. He's the Senior Vice President of Acquisitions and Dispositions for Core Pacific Advisors and CRHMI. Mr. Billsten has over 24 years of commercial real estate experience. From 2008 through to 2015, he was responsible for leasing of CRHMI's commercial property portfolio consisting of office, industrial, and retail properties. And over the past 7 years, him and the team have successfully negotiated over 500 leases totaling over 5.5 million square feet with an aggressive gross lease value of over $320 million. So, without further ado, Nels, it's great to have you on the show. Welcome.
Well, thank you. Glad to be here.
So before we get into that, maybe you could just share a little bit about, I briefly heard before we were recording how you got into the real estate space. Maybe you could share that with the audience.
Well, back many years ago when I was graduating my undergrad, I interviewed with a company, Arthur Anderson, which was the big consulting firm back in the day. And they gave me two choices when I came in. They said, you can either go into taxes or real estate. And I knew I didn't want to go into taxes, so that's how I ended up in real estate. And here we are all these years later.
Absolutely. I think if I was given the choice, I'd definitely go with real estate over taxes. So the first topic on today's agenda really revolves around the company Core Pacific Advisors. So maybe you could just tap in a little bit as to what exactly you guys do.
Well, essentially, we're focused on multifamily and light industrial properties. We have targeted those specific areas just because we believe in the long-term needs and prospects for those categories. Obviously, housing and the ability to provide flexibility for so many people is really paramount as we look for housing today and in the near future. And the light industrial, we really believe is indispensable as it relates to the ability to get goods and services to people throughout the country. While we have invested in other asset classes in the past, we believe that even in this changing time, as we shift more and more to e-commerce, people telecommuting, non-traditional ways of being at work, where you work, how you work, as well as how you buy and shop, those things affect the office and retail categories the most. But on the light industrial side, whether you're ordering from a traditional retailer such as a department store or an Amazon or some kind of a e-commerce retailer, they are going to be shipping those items from a light distribution warehouse.
Yeah.
So we feel like those assets are adaptable to the change in how people get their goods, because ultimately they're coming from a distribution center on a truck to your home or office.
Absolutely. I think that's probably one of the most important things that we've always looked at, is focusing on sectors that are resistant to technological innovation. And whether we like it or not, we do live in a physical world, so we buy physical things. Right. And while our retail environment might be changing in terms of where we shop, we still need to receive the actual goods. And I think the light industrial is a great space to be playing in, along with multifamily, where we all need places to sleep, essentially. So touching in a little bit more on yourself, maybe you could just dive into your specific role, what you're looking for in the company, and what you're seeing in the market.
Well, I'm responsible for the acquisitions and ultimately, later in the deal cycle, the dispositions or sale of the assets when they come full term. I mean, really what we're trying to focus on here is, what we consider to be defensive, risk-averse, yield-oriented investments. And what that really means is investments in markets where we believe there's not a lot of volatility. We don't see them as being as susceptible to some of the downturns that are inevitable when you're looking at a 7 or 10 year hold horizon. So, whether it's a state capital, whether it's in a market that has proven in the past to be somewhat recession resistant, markets that don't tend to get as overbuilt and maybe as frothy at certain points in the cycle are all things that are considerations for us. So what that ends up meaning a lot of times in our situation is we tend to invest heavily in the Midwest, Mid-South, central parts of the country, a little bit less on the coast than other people.
Okay, great. And tell me, in terms of the specific asset classes you focus on, so you've got light industrial and you've got multifamily. If we were to drive into those sectors a little bit more, what's kind of the unit counts you're looking at, which classes, and maybe you could just delve into that a bit.
Sure. I'll start with what we look for on the light industrial side. The light industrial products that we typically look for are what I'll call, second generation. They're not brand new, but they're still extremely relevant to the world we live in. And what that generally means is that we're not going to buy the brand new building at the edge of town.
Yes.
We typically like to try to find the opportunities that are more infill, but still have the physical characteristics necessary to thrive in today's environment. A quick example of that would be an opportunity, CPA Franklin in Indianapolis, Indiana, where the building, while it was built in the 1970s, has been updated with modern ASFR sprinkler systems, has sufficient clear height, and is only 1/2 mile from the major interstates. So when you combine those factors along with being able to buy that type of a property well below replacement costs, we think that has a lot of intrinsic value and ability to perform well in the coming years. On the multifamily side, a little bit similar. We like to buy property that might be 10 to 15 to 20 years old.
Yeah.
What that's going to give you is a lot of the modern amenities of the newest product without having to necessarily be the ones to set the market on the upper end.
Yes.
We like to try to find the ability to, where there's a healthy delta between the today's state-of-the-art properties and what were the Class A products of a decade or so ago, and be able to capitalize on the difference, that delta, if you will, and over time, making incremental increases, but still not being the ones to have to, push the market to new levels. We think that, especially like I said, looking at it more of a defensive standpoint, that you can offer most of the same amenities and lifestyle as the newer product, but do it at a more value-oriented price.
Okay. And in terms of the cap rates in those markets, what are you kind of finding and targeting, and is it important to you that you're buying on the basis of a historical cap rate, or are you generally more forward-looking?
Well, I think we consider both. The reason that, if we're going to default to one or the other, the forward-looking really takes into account many things that sometimes looking backwards can't do. And a classic example of that would be you're going to have the readjustment typically in property taxes that occur at the time of sale. So being able to look forward is really important, because while obviously it's a good barometer to see what the property's done historically, if, for instance, an owner has owned a property for many years and the property tax expense is quite low, that doesn't necessarily give a full picture of what the performance is going to be going forward. So we look at that. We also look at making sure we have the proper insurance.
Yes.
Sometimes you see properties, legacy properties, that are underinsured, and you realize during the underwriting that there's no way, should something catastrophic happen, that you could replace the buildings at, given today's cost. Sometimes, over time, owners don't realize it, but they become underinsured. In addition, we always want to make sure that if a property is in an area with any special considerations, for example, a wind policy, a flood policy, things that could be affected by major weather events or have a decent likelihood of happening, we want to make sure the investors are protected from those things. So because of that, the go-forward look is vital to us. And while, like I said, we do definitely look at the historical performance, but to be able to take those specific factors in looking forward is key to us, particularly on the multifamily side, as you often see those numbers have gotten artificially low in the years leading up to a sale.
Yes, absolutely. Okay, and in terms of the acquisitions of the firm, you're the perfect person to speak to for acquisitions and dispositions. So what's been your favorite deals that you guys have done in the last 12 months?
Well, we our favorite deal is probably the CPA Cross Lakes, which is a multi-tenant industrial deal in Grand Rapids, Michigan. That's been fully syndicated. One of the reasons we really like that deal is we have had a lot of experience with Midwest industrial product, specifically in West Michigan. We were able to buy that property at an attractive price, but really what has been exciting for us is immediately after buying, we were able to strategically do some additional leasing and restructure some leases to the point where in the second year of operations, we were already at year 6 of our pro forma.
Wow.
On the revenue side.
That's exciting.
So, obviously, much better than expected. Yeah, much better than expected, but a real fun one to be a part of.
And what did you, if you were to kind of reflect on the acquisition now and just look back, what are some of the telltale signs that you'd be able to look for to try and replicate something like that?
Well, like I said, we have been in that market for better than 15 years, had a lot of success in that marketplace, and I think we were fortunate in that our existing relationships in the brokerage community back there were enabled us to jump in and be a credible buyer and push ourselves ahead of some of the other folks that were looking at that deal. I think there's no question that I had a previous business relationship with someone on the selling side of things that was favorable, so I think that helped us. And then the brokers knew us, knew we were people who would perform and get the deal done. And again, the combination of those two factors, I think, helped us get to the top of the stack. Because as everyone knows who's active in the acquisition world right now, it's very common to have 25 qualified offers on a particular asset. Yeah. And
it's very difficult
it's difficult to navigate that sometimes, and in order to separate yourself from the bunch and not get in the position of having to grossly overpay to do so.
Absolutely.
So we try to do what we call kind of a knockout punch of being able to say, hey, here's our offer, check our references, we have the lending relationships. If necessary, we've put the chairman of some of our major lenders on the phone with a seller or a broker in order to say, hey, these guys
Credible.
Get it done, you have my name on it, don't worry about the financing, I've already blessed it, it's ready to go. And then we're fortunate that we have a strong chairman and principals who have strong balance sheets, who have the ability to either capitalize the deal themselves or in conjunction with the lenders I just spoke of, get the deal done. And then finally, the track record of performance where, check with the other brokers and sellers, people we've done business with in recent years. These are people, their word, if they say they're going to get it done, they're going to get it done. They're not going to arbitrarily try to retrade on the price.
So important.
So,
Yeah.
those are the things I think that have helped us be successful because, like I said, otherwise it's very hard to separate yourself from everybody else.
Yeah, absolutely. And in terms of your favorite disposition, have you guys gotten rid of any assets in the last 12 months?
Well, we sold a apartment complex in North Carolina that we had gone full cycle with, and we were very fortunate. It was one of those opportunities where the value add interest has just accelerated to such a degree that it blew past all of our expectations. And we had,
Wow.
Part of our discipline from an asset management standpoint is to kind of monitor values, particularly as you get up to the final years of the loan. Because
Yes.
obviously, you're going to that decision matrix
Yes.
of when do we sell.
Time to make a call.
Right.
Yeah.
And so you watch it really closely, and we had a deal.
And how do you, sorry to
Go
interrupt
ahead.
you, but how do you normally manage that when you are coming up to that balloon payment?
Well-
Because obviously you don't want to wait until you're in your final year.
Correct.
Unless you're very confident in the market or in yourself or your cash reserves, so to speak. But how do you generally manage that payment? Because it's one of the things that is interesting coming from South Africa is we don't typically have financing that works with a structure like that. So we always, the end of the mortgage or the loan is always the end of the amortization period. There's generally not a balloon situation
Right.
and the creative financing that the US has come up with on these products. So how do you guys determine when is now the right time to kind of look at it, moving on?
Well, it's a great question. Obviously, the good news is we know what the date is. So
Yeah.
as we venture down the typically a 10-road journey, we reach out to a number of the brokers in the area and have them do broker opinion of values, what we call BOVs, on a regular basis, leading up to those final years and months.
Yes.
And what that does is it helps establish a baseline. And the reason we have more than one done and from different firms is to validate, what each other are saying.
Yes.
As opposed to, perhaps somebody having a different viewpoint. And we like to try to take the different perspectives into consideration so that we really can present our owners with, the best opportunity in terms of what we think it's going to bring and when and why we want to list it at a certain time. It's much like taking something out of the oven. You don't want to pull it out too soon,
Yeah.
but if you leave it in there too long, you're going to have a lot of problems as well.
That's it.
So we really do have to kind of walk
Try
that
and manage
tightrope a
that.
little bit. And the good news again is I think we have the relationships that have largely guided us, very well in terms of what to expect when you do bring something to market. However, like I mentioned, this opportunity in North Carolina specifically,
Yes.
we had thought that the property might bring somewhere, a couple of years before we actually listed it. We were thinking it might be worth 11 or 12 million dollars, and even a year out, I think we were maybe up to 13, 14, and at that point is when the value add world just got extremely active and people
Excited.
started doing extraordinary offers and things like that. And I got to tell you, this was not our most attractive deal from being on the selling end. I was a little concerned. It was a
Yes.
45-year-old deal.
Yes.
It needed a lot of work. It really didn't fit our investors' profile going forward. So
Yeah.
it was definitely going to be
Couldn't hold
something
it.
we were going to get out of.
Yeah.
And it ended up trading for well over $19 million.
Wow.
And really that nobody anticipated that. The brokers didn't anticipate that, but we were
Wow.
fortunate. We ended up with such a competitive environment that people kept leapfrogging each other through the bidding process, and we had multiple rounds of offers and eventually settled on something, like you said, north of
Yeah.
$19 million, where literally a year and a half before we were looking at 13, 14 million at best. So
That is
that was fun to
unreal.
be on the selling
receiving
side
end
of
of
that,
that,
because
yeah.
obviously on the acquisition side we sometimes feel like we're always the one having to get caught in that accelerated buying process.
Yes. And what do you make of the value add strategy in today's market, where it seems like every single person's basically chasing for the same thing, but the reality is on a deal like that, when you do overpay on a value add and you spend the capex to bring it up to a certain level that you think is going to generate the rental premiums, and it potentially doesn't, then suddenly you bought at a 5.6 cap, and suddenly you were pro formering it to be a 5.6 cap, let's call it that, and suddenly you're stuck at a 4. Is value add a strategy you guys like to deploy a lot, or is it more other efficiencies that you're looking
No,
for?
we really are, while obviously many people have done it successfully in recent years, we feel that our investors are ultimately not looking for that type of investment. And what I mean by that is, for example, we have a multifamily investment right now, CPA Barrington Apartments in Montgomery, Alabama, where the yield in that investment is not driven through the assumption of any value add program. It's a operating yield that starts at 6% and gradually works its way up. But this isn't something where, in order to get to the 6%, we have to go in, do a lot of heavy lifting, and hope we're able to get higher rents once the renovation is done. Obviously, it's a valid strategy. It's just not one that we feel as confident in for our investors right now, particularly given the run-up in prices the last 5 to 7 years. We feel that if we really want to protect them and to provide more of a defensive investment for them, we would rather provide something that's not dependent on the value add execution.
Yes.
Because while certainly you might get a $200 premium on the other end, what if it's only 50 or 75? And so, like you alluded to, then you don't hit your returns.
Absolutely.
And our crystal ball, we don't know when the value add frenzy, if you will, is going to slow down, and we don't want to be the ones left holding the ball at the time it does.
Yeah, absolutely. So buying with in-place cash flow then, I suppose, is the real model and the key to making sure that doesn't happen. So I feel like this could turn into a 2-hour podcast if I get to ask all the questions I'd like to ask, because there's a lot of knowledge and I'm enjoying all of it. But I think I'm going to try move into some of my top 3 learning questions over here. So the first one is really around, what are your personal top 3 to 4 metrics that you look at when you're doing a desktop review of a property? So in terms of the actual asset itself, not talking about the market, we'll go into that next.
Well, I try to look at, through my eyes, what you're buying today and how that will hold up over the next 10 years. Sometimes I'm a little cautious on buying something too far earlier than 2000. In other words, we prefer to buy assets that were built in the year 2000 or newer.
Okay.
And the reason is, 10 years from now, you're dealing with, let's say you bought an asset that was built in the year 2000. Well, 10 years from now, you have an asset that's probably 30 years old or close to it.
Yeah.
So
the equivalent of a 90s
that just
asset,
feels to us, unless you have something that was, where there was an exceptional opportunity that was built in the years prior, that's probably a good dividing line for us, because what ends up happening is, as I spoke of earlier, the amenities and lifestyle designs changed a lot through the 80s and 90s.
Yeah.
And they obviously continue to evolve today. But we feel like, by the time you hit year 2000, the majority of properties had a lot of the, what I'll call the key attributes that you really need in order to attract and retain the right residents. For example, they're going to have the washer dryers in the units.
Yes.
They're going to have the 9-foot ceilings.
Yeah.
They're going to have a lot of the security features through interior hallways and things like that, as well as some of the property amenities are clearly going to be at a different level. Typically,
Yes.
on a 21st century property, whether it's the pool, the workout room,
Yep.
business center, et cetera, are going to be at a different level.
Very different.
Than a property that has a 80s or 90s vintage.
Okay. And so you're looking at the year. What else are you looking for? You mentioned earlier on you're looking at historic cash flows, so you want to be buying at a decent in-place cap rate after making adjustments for the real estate taxes. What's kind of are there any other metrics that you're specifically looking for in terms of a cash on cash? Maybe on a cap rate figure, it'd be interesting if you have one.
I mean,
in mind.
we try to chase something that is as the mid 5s to 6 or above. And again, we are recognizing that our investment returns are going to come primarily through the yield. We love appreciation, but it's not our focus right now, because the investors that we talk to and the broker dealers we talk to, the investors are focused on how much did they get at the end of the month. And while they might love the fact that 10 years from now they or their heirs will get a nice capital gain at the time of sale, most of these people are really looking for what can they count on and rely on each
cash
month.
Flow.
And so therefore appreciation really takes a back seat to the ability to achieve and maintain a strong yield for the extended holding period.
Okay. And in terms of markets and sub-markets, what are kind of the main things that you're looking for when you're making an acquisition?
Well, we obviously like job growth. We like university towns. We like state capitals. We're definitely focused on the Sun Belt. The what we'll call kind of the business friendly population growth states.
Yes.
Whether that could be anywhere from Texas to Florida on the southern boundary, but it could be anywhere from Virginia to Oklahoma as you move across the country. So southeast, mid to south Atlantic states, Carolinas, Virginia, and then some of the mid-south states too, Tennessee, Alabama, Georgia. So definitely that sector of the country we think holds the most promise for the long-term positive economic trends. We continue to see migration in the United States from the older northern cities to those states, and so we feel over time those are the places we want to be.
Okay. And then the last question is, or specifically from a learning perspective, is what's the 2 most important things you've learned after all your time in the industry that you wished you'd learned sooner? So for someone up and coming and learning and making their first few multifamily acquisitions, what is some of the value that you can maybe bring to them in terms of your experience?
Well, I think the first thing is focus on the deals that you can actually do, and what I mean by that is don't fall in love with a deal that you're not going to be able to have a very strong chance of acquiring. It's easy sometimes to see a great real estate deal, and while it might be a wonderful real estate deal, is it the best real estate deal for your company, for your company's focus, and for your investors? Likewise, just don't try to make things fit. And therefore, your time is the most precious commodity you have as an acquisitions person. You got to make it count, because you can't just start chasing all these deals all over the country. Really focus on being able to identify quickly the type of deal that you're looking for, that you're not going to have to sell internally to your investment committees and to the company principals, but the type of deal where fits your model, and that you also feel like you have a solid chance, whether it's because of relationships you have with brokers, knowledge of a specific region or community, just where you know it gives you a leg up versus being, I don't like being one of 25 bidders and having no inherent advantage to anybody else. I want to be in a situation where I know at worst I'll be in the top 3 to 5 finalists and have a solid chance of being able to acquire the deal if it makes sense for us.
Okay. And then for the second thing, what would you say from a due diligence perspective is probably your most important thing to make sure you've covered?
Well, I like to talk to the operations people on site, specifically the maintenance folks. While everybody who has a financial background is going to be able to pour through the financial statements, pour through the market reports, and be able to put together a credible financial model, I like to hear some of the the perspective and experience that the people on the ground have had. They will give you insight into the real challenges that you might be experiencing at the property, things that won't show up
on the statements,
on the financial statements that the broker will never tell you, and that only someone who's been living, working, and involved with the property for an extended period of time could relate to you. So, that's something that I've always done, probably because I grew up in a general contractor's family. But oftentimes those people are extremely knowledgeable and can give you some great insight, not only to what might be wrong with the property, but also some of the things that they see as opportunities to improve the property, whether it be cost-saving opportunities that maybe for whatever reason the existing owner hasn't embraced, and just it starts the conversation as to how you can make those improvements immediately upon the acquisition, because I think the key to executing that business plan is to be able to implement the ideas and principles that you're looking for as quickly as possible.
Yes, absolutely. Thank you, it's very valuable. And then the last thing that I wanted to touch on was, I'm from a background where we've typically raised equity through syndication models. I know that you guys focus more on broker dealers. Maybe you could just speak to that and just enlighten us a little bit around how that actually works.
Well, the broker dealers are often, financial planners are associated closely with the investors, tax consultants, CPAs, what have you. And so, these are generally small business owners. They represent family money, maybe a couple of generations. And so their perspective, their goals are often very unique.
Yes.
And from one group to another. Some of the things we shared, we touched on, is many of them are looking to preserve capital more than to continue to acquire it. They're many of them are at a stage in life where they have accumulated a significant amount of wealth through real estate, but are vulnerable to taxes.
Yes.
And so they have a huge tax exposure should they go through a traditional sale and not do some kind of a tax exchange investment. So, oftentimes the focus is, like I said, unique. They're not going to be focused on, necessarily a redevelopment type opportunity in a coastal city where there's a huge risk-reward dynamic going on. They typically are a lot more risk averse. Many times they want to diversify their investment into several different properties or property segments. And ultimately, these are people that don't want to get involved in the day-to-day at this stage of their lives. They want to be able to hire professionals who will do a competent job, and they want to sit back and collect those checks. So,
Absolutely.
they may have been very aggressive at earlier stages of their life, but much like, stock and bond portfolio investing,
Yeah.
as you move towards, more mature years, you're looking for a very different type of return that you may have looked at when you were in your 20s or 30s and you're willing to take a lot more risks.
Absolutely.
These are folks that if they were to lose capital might not have enough years remaining to recover it adequately.
Yeah.
So.
Okay, so I think you've answered the one thing really well in terms of what the investor profile would be for you guys. If someone wanted to invest specifically with yourselves, who would they contact or reach out to? Is it only through broker dealers? Do you take direct investment?
They could. We don't exclusively work through broker dealers, although the majority of our investors do have a financial representative. But they can contact Michael Crimmins, and he's at the CPA.
Okay, I'll link that down below for anyone who wants to get a hold of him. And then finally, assuming I am a broker and I come across deals, what are you looking for any brokers out there listening? If they have a listing that comes through, just to make sure that it's meeting kind of your mandate and what you're looking for. You've touched on 2000 vintage. Maybe you could elaborate a little bit more on the unit count and some specifics around the light industrial so that they
Sure.
can reach out to you.
Well, from a multifamily standpoint, as we detailed, typically year 2000 or newer, typically 250 units or greater. Typically, cap rates 5.5 or better, and deal size 20 million to 35 million is our sweet spot. That's on the multifamily. The light industrial, we typically look at cap rates that are 7 or better, and deal size of 20 to 35 million as well.
20 to 35 million. Great. Well, thank you so much, Nels. It was great having you on the show today. I really appreciate your time, and it's a privilege to be out here at your offices close to Newport Beach. I think I'm going to head out there afterwards, just see what all the hype's about. And yeah, thank you so much for being on the show. That concludes today's episode of the Creative Real Estate Podcast. And just like that, ladies and gents, we've concluded another episode of the Creative Real Estate Podcast. If we brought any value to you, please go ahead and share the podcast or subscribe to all our other social platforms for additional content. From me to you, thank you for your time, and remember to stay curious and keep it creative.